Yesterday, Ariel Investments held its third gathering of top value investors. The event focused on the challenges of trying to manage portfolios in what we have seen to be a very volatile market. Collectively, the participants at the events manage more than $350 billion in assets. Joining us right now in a Squawk Box exclusive interview is Melody Hobson. She is the co-CEO and president of Ariel Investments. And by the way, she moderated yesterday's panel discussion. And we also have one of the veteran value investors, Bill Miller. He's the chairman and chief investment officer of Miller Value Partners. And folks, welcome to both of you. It's really good to see you guys. Melody, I want to start off with what we just heard from Steve Leisman. I know this had to be front and center for you all yesterday. What's happening with inflation right now and how we expect the Fed to react, especially with the additional growth in inflation and inflationary pressures coming from the Ukraine invasion. What do people think right now? How did these investors get their heads around this?
We had 7 great investors on the phone, all on the Zoom, all value investors, all very well known for what they do. And they had one belief in common, which was that the Fed would be very, very hawkish this year. I was really surprised by how aggressive. Between the group, they expected somewhere between 4 and 6 rate hikes this year alone. And they thought that the Fed their hand was forced, that they were going to have to move in order to get inflation in hand.
Hey, Bill, let's talk about that because this is the biggest question the markets are kind of grappling with right now. We just heard what Jay Powell is expected to say in his prepared remarks. Maybe it's his responses to questions that'll tell us a little bit more. But do you think the Fed is going to take a more aggressive stance because of what's just happened with Ukraine? Are they more worried about the economy at this point, or do they really have to keep a laser focus on inflation and make sure that they are incredibly aggressive?
I think they are what they say they are, which is data dependent. So I think that they clearly know that they're behind the curve right now, and they'll be raising rates somewhat this year. I was in the 5 camp, but I think I'm less worried about inflation, actually, Becky, than I guess most people are, because if you look out to the 5-year inflation expectations, it's high. It's 3.2%, but that's not high historically. That's about in line with historical inflation going back to the 1920s. And if you look at companies like Cleveland-Cliffs, for example, the big steel company, I mean, the steel price is expected to fall significantly next year. So I think that right now inflation, headline inflation, is a problem, and it's a problem for the American people. But also, I think that inflation is going to be dropping over the next few years. So I think inflation expectations are what we need to keep our focus on, and not headline inflation.
Does that mean that you are incredibly bullish on the market at this point? If that's the case, if inflation is not as big of a deal and you're looking at the economy we have right now, that does seem to be a pretty good reason to buy.
Well, the market's down a lot. I mean, a lot of stocks are down 50%. You know, a lot of the high flyers that really great investors like James Anderson at Bailey Gifford and Dennis Lynch at Morgan Stanley and Kathy Wood, for example, at ARK, who have made their reputation on these, they're mostly in half. So I think there's some opportunities there. They're not cheap. They're just cheaper than they were. But there are a lot of cheap stocks out there. I mean, Tenneco, which I own, Tenneco was just bought out at double the price, and that was 4 times earnings. The buyout price was 4 times earnings.
So when you look around, are there things in the oil patch that you're looking for, things in technology? Where are you kind of thinking, all right, these are some of the best places to be right now?
Well, Amazon has lagged the market for the last 18 months, and that's our biggest position, and we've owned it forever, so that's not anything new. What is new is that we went overweight oil spring a year ago. That's the first time in 35 years, and oil stocks right now are cheap, and they're very cheap at current oil prices, but they're cheap at $60–70 of oil, and there's a lot of capital discipline there. So we think that there's opportunities there, and great opportunities in home building. Taylor Morrison's one of our big positions. It's under 4 times this year's earnings. So, and they're buying back stock. They have a 20% return on invested capital.
Melody, let's talk a little bit about what you heard from the panel overall yesterday with Ukraine. How big of a problem does this pose? How much uncertainty does it add? And are people nervous about this when you talk to that group of investors?
I think they were obviously very, very concerned about the country, and everyone expressed their just heartfelt support for the Ukrainian people. So first and foremost, I think when it comes to the markets, they felt that the biggest risk was to Europe and to a European recession potentially primarily because of energy prices, and that would really, the cutting off the Russian supply could affect the European continent in a way that could be pretty significant. So Europe was the follow-on effect to Putin's advances, and that's where the greatest concern was. Beyond that, they were fairly optimistic about the volatility and being able to use that to their advantage in this current environment. People were leaning in to that volatility and buying on the margin lots and lots of names that they thought were being cut off at the knees for probably unfairly, just unduly punished. There was widespread consensus that the one area they were all very excited about and thought we were in early innings was travel and leisure. Across the board, the managers owned stocks from airlines to hotels to casinos. There was a lot of enthusiasm for that space, believing that as the world reopens, it will continue to reopen in a big way, and there's a tremendous amount of pent-up demand.